For 40 years, the silver market ran on confidence, not metal, confidence. If you wanted silver, you didn't need a bar in your hand. You needed a login, a statement, a line in a database, and a promise that somewhere, somehow, a vault and a bank had you covered. And today, silver is telling you in the loudest way possible that era is ending, because the price didn't just rise, it broke the spell. It ripped past levels people used to treat like fantasy, and it did it while the physical market is already tight, while liquidity is thinning into year end, and while the world is suddenly remembering what a real commodity looks like when it stops behaving like a spreadsheet. As of today, Monday, the 22nd of December, 2025, silver has printed fresh all-time highs in global markets, moving through the mid-60s and into the high 60s, with some feeds showing spikes even higher intraday. So in this market update, I'm going to do two things. Explain why silver just hit 67 and why it didn't stop politely. Explain what this move means, not as hype, not as a meme, but as a system shift. Promises versus proof. And I'm warning you now, if you only watch the chart, you will miss the story. Because the story is not silver up. The story is the silver market changing how it functions. Let's anchor the moment. Today, precious metals are on fire. Gold is ripping to records on rate cut expectations and safe haven demand. And silver is doing what silver does in a regime shift. It's not walking, it's sprinting.
Reuters is describing silver hitting new records with a violent year-to-date move, and other market coverage has prints pushing into the high 60s and even near 69 on some benchmarks.
And here's the thing, nobody tells you when a metal does this. When silver starts moving like this, the price is not just a price, it becomes a stress test. It tests the plumbing, it tests the paper, it tests the willingness of sellers to deliver, it tests the ability of the market to stay orderly. So the question is not, is 67 expensive? The real question is, what kind of market prints 67 and still can't relax? In the last few years, three things happened at the same time, and together they built the runway for what you're seeing right now. One, industrial demand hit record levels. Solar, electrification, grid infrastructure, electronics, data centers. Silver is not a decorative metal anymore. It's an input metal for the world we're building. The Silver Institute has described industrial demand reaching record highs in 2024-680, 5 million ounces, with structural drivers including photovoltaics, electrification, and AI-linked electronics demand. Two, the market ran repeated physical deficits, multiple years where demand exceeded supply means inventories don't sit there just in case. They get eaten. The Silver Institute has described a structural market deficit in 2024 of 148.9 million ounces, noting it as the fourth consecutive annual deficit. Three, the paper buffer got smaller. Regulation plus balance sheet cost. After the global financial crisis, banking changed. Basel reforms and liquidity rules made it more expensive for banks to carry certain kinds of exposures, especially opaque, balance sheet heavy positions. Even in precious metals market discussions, the net stable funding ratio and how banks treat allocated versus unallocated exposures became a real constraint, not a theory. So combine them, more real demand, repeated deficits, less infinite paper cushioning, and the system begins whispering something terrifyingly simple. No more paper games if you don't have the metal. That's the backdrop. Now let me show you how that backdrop becomes a day like today where silver doesn't just rise, it escapes. Let's not start in a trading room. Let's start in India, because India is where silver stops being theory. India is one of the world's biggest silver consumers, and when India pulls, the supply chain feels it. In 2024, India's silver imports surged so hard that major reporting described it as importing more silver in 4 months than in all of 2023, with numbers around 4,172 metric tons in the first 4 months of 2024. And then the plot thickened. In September 2025, India restricted certain silver imports until the 31st of March 2026, moving categories from free to restricted, requiring licenses. Now pause. That is not a chart story. That is a permission story. And permission stories do something charts hate. They create two realities. Because when imports tighten, while global demand stays strong, the screen price and the street price stop agreeing. And today's India tape is screaming. Silver is at historic highs domestically too, with MCX records being reported around the 213,000 rupees per kilogram zone and above on record days. Same metal, two realities. That's the preview. And if you understand that preview, you understand why 67 doesn't feel like a top. It feels like a door opening. The trick we lived in, fractional metal banking, simple metaphor. To understand why silver can hit 67 and feel like the beginning, you have to understand the trick we lived with for decades. For a long time, the silver system, especially in London and New York, ran on something that looks a lot like fractional banking. Not with dollars, with bars. Here's the core mechanic. Big bullion banks sit between miners, refiners, industrial users, ETFs, and investors. They run unallocated accounts where silver is a claim, not a specific bar. They hedge with futures, forwards, swaps, and the entire machine assumes not everyone will demand delivery at the same time. So on paper, the market looks enormous. In reality, a relatively small pile of deliverable metal can support a much bigger tower of claims, as long as trust holds. It's like a high-end restaurant taking 100 reservations for a room with 50 seats. It works because people arrive at different times, and some don't show up. But if everyone arrives at once, now you're not running hospitality, you're running panic. And silver at 67 creates everyone arrives at once psychology. Because when a market prints a number the public remembers as impossible, you don't just get investors, you get converts. You get people who stop asking what's the price and start asking, can I still get it? That question is radioactive to a fractional system. The inflection point. Why the paper cushion matters less now. Now we zoom out. The global financial crisis changed banking. And afterward, global rules were designed to make banks less fragile. One of the core ideas behind those rules, if you're holding assets that can become illiquid, you need stable funding and real capital to support them. And when the precious metals market relies on balance sheet capacity to intermediate flows, those rules matter. Even LBMA-linked discussions and documents around the NSFR and clearing settlement highlight how sensitive the system is to how unallocated balances and metal positions are treated. If it costs more capital to run big opaque metal books, banks do less of it. And if banks do less of it, the market loses a shock absorber. So when demand hits, when volatility spikes, when people rush toward delivery, there's less paper supply ready to flood in and calm it down. This isn't about conspiracy. This is about capacity. And you can literally see market coverage pointing to a perfect storm of investment demand, speculative momentum, and supply deficits pushing silver into record highs. Why this move is happening right now. Now let's talk about today, because this is a market update. Today's silver spike isn't one thing. It's a stack. Driver one rate cut expectations, and the real yield story. When markets expect easier monetary policy, precious metals benefit because the opportunity cost of holding a non-yielding asset changes.
Today's reporting is explicitly tying record gold and silver moves to expectations of further rate cuts plus safe haven demand.
Driver 2, safe haven bid geopolitics plus trade tension risk premium. Silver is not pure safe haven like gold because it's also industrial. But in a risk-on panic, silver can behave like gasoline on a fire. Thinner liquidity, more leverage, sharper moves.
Market coverage today explicitly frames precious metals records in the context of geopolitical and trade tensions and safe haven appeal.
Is quartz. Driver 3, supply constraints plus deficit psychology. When a market has been in repeated deficits, it becomes hypersensitive to demand surges, especially when buyers fear future availability. This Silver Institute's deficit framing and record industrial demand framing are the backdrop. Driver 4, silver's structure, smaller, less liquid, more explosive. Silver isn't gold, it's a smaller market. When flows surge, price can gap faster. Reuters has explicitly noted silver's volatility and how it can amplify moves because it's a smaller, less liquid market than gold. Driver 5, the story catalyst loop. Here's the loop that matters most.
Price breaks a historic level, headlines hit, attention floods and liquidity thins, momentum accelerates, shorts cover, the market overshoots.
This is why silver can move like a trapdoor. It doesn't climb stairs. It finds an elevator shaft. And if you're watching this around year end, when liquidity can be weird and positioning can be fragile, those moves get uglier. Which brings us to the mechanics nobody explains. The mechanics. Why silver at 67 can move like a stampede. Let me describe what 67 does to market structure. When price moves into new territory, 3 mechanical things often happen. Margin pressure hits the wrong people. In leveraged markets, a fast move forces margin calls. Margin calls force covering. Covering becomes buying. Buying becomes acceleration. This is why a rational price target can get obliterated. The short side becomes a liability, not a strategy. In a steady market, shorting is a trade. In a regime shift, shorting becomes a countdown timer. And as shorts cover, they become forced buyers right into illiquidity. The derivative tail wags the physical dog until it can't to. For decades, paper could dominate price discovery because the system assumed delivery demand would stay manageable. But when physical tightness rises, paper gets tested. And on weeks like this, record highs, headlines, and risk paper gets tested hard. This is why this move doesn't feel like a normal commodity rally. It feels like the market is asking, okay, who's actually got the metal? London vaults. Why total is not the same as available. Now this part matters because people throw around inventory numbers like they're all equal. They are not equal. LBMA publishes vault holdings data, and their market reports have discussed silver stocks in London, vaults numbers in the hundreds of millions of ounces. But here's the key. Held in London vaults is not the same as free to move. Some of it is tied to ETFs. Some of it is allocated. Some of it is spoken for. So the market can have inventory and still have tight float. That's why the stress shows up in premiums, lease rates, delivery delays, location-based shortages, and the way price reacts to relatively small flow changes. And when you combine that with what we discussed about India, import surges, import restrictions, this becomes a global flow chessboard, not a simple supply pile. What all-time high means in this regime. Now let's address the elephant in the room, all-time high. Those words are gasoline, because once a market prints a new all-time high, it rewires people's expectations. Before, Silver was the metal that couldn't hold highs, couldn't break out, couldn't escape the old ceiling. Now it has, and this matters because when a ceiling breaks, it stops acting like resistance. It starts acting like memory. And memory creates two kinds of buyers. The buyer who says, I missed it, I need any pullback. The buyer who says, pullbacks might not come the way they used to. That tension is why the next phase is usually violent. Not because it must go up forever, but because positioning resets are messy. And Reuters has already framed this rally as historic in annual performance terms, driven by a combination of investment demand, momentum, and supply deficit narrative. The three failures, your banks failed definition, updated for this market. So when we say banks failed, we're not talking about bankruptcies. We're talking about three failures of function. Failure one, they failed to remain an invisible, cheap balance sheet bridge. When capital and stable funding rules bite, it changes how much intermediation banks can economically provide in metals. Failure two, they failed to keep price discovery comfortably paper dominant. When physical tightness and investor demand surge together, paper dominance gets stress tested because delivery becomes a louder question. Failure three, they failed to stop metal from migrating toward do not come back hands. Industrial and strategic demand absorbs metal into long-term use. And in that world, the casino has fewer chips. Banks didn't die. They lost the ability to be the cheap, invisible backbone of an infinitely elastic paper system. And when that capacity shrinks, the market has to re-anchor itself in physical constraints. That's the physical discipline era. And silver printing 67 is exactly what that era looks like. The three rules of the physical discipline silver era. Rule one, if you can't deliver, you can't dictate. In the old system, contracts could steer price. In the new system, delivery capability sets credibility. Industrial users care about shipment, bar lists, custodians, timing. If you can't answer those, your paper sophistication matters less. Rule two, above ground stocks are the new central bank. Gold has official reserves. Silver doesn't have the same anchor. So the market stability reserve is above ground stocks, exchange inventories, vault holdings, industrial buffers. And when deficits persist, that reserve becomes more precious. The system gets more sensitive to shocks. Rule three, industry sets the floor. Monetary fear sets the ceiling. This is the most important mental model. Industrial demand consumes silver because it performs at some price. Substitution and thrift kick in. Below that, industry gorges because performance matters. That's the floor dynamic. Then monetary fear sets the ceiling pressure. When trust in currency and bonds shakes, investors rush toward metals. Gold first, silver second. And in a tight physical regime, that investor wave can slam into an already constrained supply chain. That is how you get moves that look insane. They're not insane. They're two demand engines colliding in a smaller market. Okay, but why 67? Why not 57 or 77? Because numbers are not just math. They're psychology. 67 is a signal flare. It tells the world this isn't a normal range. And once you leave a normal range, the market's behavior changes. Sellers hesitate. Shorts cover faster. New buyers arrive with urgency. Volatility becomes the main character. And the macro tape today supports it. Markets are pricing in easier policy. Safe haven flows are strong. And precious metals are printing records together. So 67 isn't just a price. It's a social event. It's an alarm. It's the moment silver stops being that metal that never breaks out and becomes that metal that might not be available the way you think.